finance, a la shmup. How does a hedge fund work? So you've probably heard a lot about the huge fees that hedge funds charge for the privilege of managing your money, that hedge funds are only investing vehicles for the wealthy, and how mathy their employees are. But the actual workings of a hedge fund are a lot like driving down a road in wartime. There are hills and there are valleys your car will traverse, wanting it to speed up and slow down. But as long as you continue to drive 37 miles an hour, the enemy radar can't detect you, so you drive, theoretically, safely down the road. All right, so how does this translate to financial investments in a hedge fund? Well, essentially every investment made on an entity going up in value is usually offset by making a bet on a different entity going down in value. That's called hedging. Got it?
Illustrative example time.
The economy is coming out of the doldrums, and you believe the entire stock market is going to recover, but you believe the worst companies, which have been down some 90% in this bad bear market environment, will actually do better over the next period of time than high-quality companies like Coca-Cola, which didn't decline as much. That is, yes, Coca-Cola stock will improve, and you think it has headroom to run upwards some 30% in the next year and a half, but you believe crapburgers.com, which went from $100 a share at its peak to only $2 today, could quadruple to $8 in value over that same 18 months. Like, you get a much better percentage return on crap burgers than you do on Coke. So as a hedge fund manager, one quote easy unquote trade that you'll make is to short Coca-Cola, betting essentially that it will go down, and then putting the same amount of money to being long crapburger.com, betting essentially that it'll go up. In essence, the bet that you are making is that Crap Burger will go up a lot more than Coca-Cola will go up. But if the overall market goes down, well, you'll be hedged in that your short Coca-Cola position will cushion the blow of Crap Burger's further demise, and it's likely you're looking at Crap Burger's balance sheet and thinking, well, they have $2 a share in cash and no debt. How much lower can they go? Got it? Hedge funds use stock options aggressively to manage risk in their portfolios. The promise hedge funds make to investors is that their performance will be up and or good, whether the market goes up, down, or stays sideways. So another common hedge trade involves the use of put options on the market to protect the long trades the fund is making. Specifically, a hedge fund might find 3 S&P 500 stocks it really likes and believes that they will be up significantly over the next 2 to 3 quarters earnings reports, but it's also nervous about nukes in North Korea. In order to protect against a bomb going off and the whole market going down and ruining its investment performance, and yes, there are bigger things to worry about then, but that doesn't matter to hedge funds, not their job. The hedge fund goes long the 3 stocks it likes, but it buys put options on the market, betting with those options that the market itself will go down. It's essentially playing both sides of the fiddle so that hopefully it wins in any set of circumstances. And yeah, it's a lot more complicated than that in practice. We're just giving the idea here. In the case of a put option, the market might be trading at 10,000, and a put option might have a strike price of 9,000, such that if the market declines below 9,000, the put option goes, quote, in the money, unquote, and pays the investor handsomely for making the bet that the market would go from 10,000 to, well, somewhere below 9,000. If that happened, the 3 long stock bets that the hedge fund made would go down, but their decline would be hopefully more than offset by the gains from the put options the hedge fund bought that were portfolio life insurance in the case the market puked. And if that happens, well, all you can really do is offer the market a breath mint and a moist towelette, and then be sure to collect your fee.